Chutzpah, noun, supreme self-confidence, or someone who has a lot of nerve or overwhelming gall. A classic example of chutzpah can be found in Leo Rosten's 1968 book entitled The Joys of Yiddish, which defines chutzpah as, quote, that quality enshrined in a man who, having killed his mother and father, throws himself on the mercy of the court because he is an orphan. A cut to yesterday when a former Bear Stearns and JP Morgan trader went on Kitco News to opine about various ongoings in the precious metals markets at the moment. I'm going to backlink the full interview in the show notes here on YouTube, but we're going to go through a few highlights here in short order. Surprise, by the way, Robert or Bob, he's got a book to sell you. It comes out sometime in Q1 next year, 2026. Let's do some public record research on this self-proclaimed legendary bullion bank trader, shall we? Oh, here's a Reuters piece written by an old journalist I used to engage with many messages during the COVID and Silver Squeeze Q1 2021 era. Peter Opson has an article here from September 12, 2019, describing how Robert Gottlieb, at the time, was named as a defendant in at least one civil suit related to precious metals price spoofing. A December 2018 class action complaint, for example, said that Edmonds, Nowak, Gottlieb, and others made hundreds of spoof orders or more as a, quote, part of a conspiracy with the bank and other internal traders. Now, I asked Google Gemini to give me publicly available information further on regarding the civil lawsuit and falling out of the 2010's alleged JP Morgan precious metals spoofing desk and the allegation that it violated the RICO Act. Well, here's what Google had to say when I asked, quote, what was the end result of the lawsuits against Robert Gottlieb at JP Morgan for manipulating precious metals markets late 2010s? Answer. The available information suggests that Robert Gottlieb was named as a defendant in a civil class action lawsuit concerning the manipulation of the precious metals markets at JP Morgan. But the specific public result of a criminal case directly against him is less clear compared to other traders. Here are some key outcomes related to the overall investigation. Civil settlement. JP Morgan Chase & Co. and three former traders, including Robert Gottlieb, John Edmonds, and Michael Thomas Nowak, were named as defendants in a class action lawsuit for allegedly manipulating gold and silver futures. JP Morgan agreed to a $60 million settlement to resolve the class action in 2022. JP Morgan penalties. JP Morgan Chase, the bank, entered into a 3-year deferred prosecution agreement in September 2020 and paid more than $920 million in criminal and civil monetary penalties, disgorgement, and victim compensation to settle charges with the Department of Justice, DOJ, Commodities Futures Trading Commission, CFTC, and Securities and Exchange Commission, SEC, related to the market manipulation spoofing in precious metals and the U.S. Treasury futures. Other traders' criminal sentences. Several other former JP Morgan precious metals traders faced criminal charges and were convicted for their roles in the scheme, which spanned from approximately May 2008 to August 2016. Greg Smith was sentenced to 2 years in prison and received a $50,000 fine. Michael Nowak was sentenced to 1 year and 1 day in prison and a $35,000 fine. John Edmonds and Christian Truns pleaded guilty and cooperated with the government. Christopher Jordan was convicted of wire fraud in 2022. The records confirm Robert Gottlieb was a key figure mentioned in the civil case and internal discussions relating to the silver desk, but his specific individual legal outcome, such as a separate public criminal conviction, plea, or sentencing, is not detailed in the available summaries, unlike Smith and Nowak. Okay, so Bob is a free man, obviously, and over the last year, he's been out and about in the public precious metals community commentary circuit, apparently preparing listeners to buy his upcoming book, Q1 2026. So let's hear from Robert Gottlieb and the interviewer, Jeremy Sabron. The clips were released yesterday, Thursday, October 23rd, 2025, and I believe that is exactly the same day they were recorded on. Have a look.
I'm Jeremy Saffron. Welcome back to Kitco News. Well, it's been a turbulent week for the precious metals market. Spot gold successfully tested the critical $4,000 psychological support level just overnight and has since staged a pretty powerful rebound, now trading in a range between $4,100 and 41.50 an ounce on the spot side. Silver, too. I mean, it's mirrored that volatility, and it's reclaiming that $48, $49 level. Now, this price action is set against two powerful narratives that seem to be quite contradictory as well. First, a new institutional thesis from J.P. Morgan arguing for a structural shift that could see gold's price double. And second, a massive physical drain from COMEX silver vaults. Now, to make sense of this, you need to speak to someone who not only understands the system, but who broke part of the story open. Our guest today is uniquely positioned to connect these dots. Robert, or Bob Gottlieb, is a former executive at J.P. Morgan's Bullion Bank, the very center of the system. He's an expert in precious metals, and he has a new book coming out called Mastering Gold and Silver Markets, Insights from a Legendary Bullion Bank Trader. A must read for our audience, I must say. Welcome to the program.
Jeremy, thank you for having me. I'm a fan of Kitco.
Oh, thank you for saying that. It's guests like you, Bob. We get the insights to our wonderful audience, and I appreciate you making the time, because we got to start with this week's sell-off. I mean, what a almost felt like an episode of something, I mean, to watch. I mean, obviously we saw gold collapse more than 200 and then rebounding, silver dropped sharply, and then the volatility across the metals complex hit levels we haven't seen since early 2020. I mean, we've seen some recovery here, but let's get into the who, what, where, when, and why. I mean, what triggered this move? Was it a pure algorithmic liquidation? Was it the market telling us something deeper about liquidity and leverage? What are your thoughts?
Yeah, it's a great question. And, I think everybody that follows me knows that I don't believe that anything goes up linear. And we've had a tremendous rally. I mean, even after the sell-off, gold is up 57% or so since the beginning of the year, silver up 69%. I believe what has happened is, so in the last month or two, a lot of pundits have come out and advocated for gold. You have Jeff Gundlach, El Arian, Ray Dalio, and many others. And matter of fact, Jeff Gundlach mentioned on a competitor network that gold has become a momentum trade, and that retail investors just getting on the radar screen with gold. I think what has happened is that a lot of retail investors in the last 2 months just got involved in gold. I would call them weak longs. And in addition to that, when we started stalling out around the 4,300 level, many people came out stating, well, maybe we've hit the top, maybe it's a bit frothy. You had one investment bank recommend a 60-20-20 portfolio where 20% would be in gold, which I think is extremely high. On the day of the sell-off, that same investment bank, a different individual mentions, have we hit a bubble? So with all this news out, I wouldn't put it past a hedge fund that saw the weakness at an all-time high and stalling and take on a short position. And with that, people don't really look, why are we coming off? They just know we are coming off and I need to get out. So trend following funds like CTAs, weak longs that obviously can't take a certain amount of pain. They just got in and they're out $200 in a week or two. I think they all exited. And I think it's extremely healthy for the market to have sell-offs. And as I said, nothing goes linear, but I believe that we're in a long-term rally still.
I got to talk about the institutional thesis and kind of its credibility. I mean, on the J.P. Morgan report that I talked about at the top, the core of their argument is that the 60-40 stock and bond portfolio is broken. What was the final straw? I mean, why, after decades of functioning, has the market's trust in government bonds as a reliable hedge completely evaporated?
Yeah, this again goes back to general economic and geopolitical uncertainty. I guess you could say it started initially with Ukraine war. I mean, we started getting a bid, and actually certain ECB central banks started buying gold, especially like Poland and so forth, right after the Ukraine war. So it's not shocking. And I believe that if you take a look at the ECB, for instance, they just announced that the number 2 holding in their reserves is gold and surpassed the euro. So if you think about that, they hold more gold than they hold their own currency on the ECB central banks. If that doesn't scream buy gold, what does?
Yeah. And I mean, I hate to keep bringing up your former employer, JP Morgan, but it has a long and complex history in the precious metals market, including paying nearly $1 billion fine for manipulation just a few years ago. I'm curious because the audience kind of wants to view this as this hyper bullish report as a genuine research call and not just as a strategic positioning piece. But what do you think it is? I mean, could they just be talking their own book, setting the stage for their clients before a major move?
Yeah, I mean, I really can't get involved in that. I mean, research was independent of, and always should be independent of trading. So they put out their own thesis. I don't believe it's connected to the trading desk. And I also haven't been at JP Morgan in over 10 years, so I can't really even talk on behalf of JP Morgan.
Yeah, on that math, I mean, the allocation shift from that 2.6 to 4.6% for gold. I'm curious, I mean, from a bullion's desk perspective, is the physical market infrastructure, the refineries, the vaults, the logistics, even capable of handling that scale of reallocation from the multi-$100 trillion bond market without, complete and chaotic price reset?
In gold, it definitely is. In silver, this is what's created part of the tightness. If you take a look, the other part of why gold is where it is not just the ECB is diversifying. The entire central bank world is diversifying away from the dollar, and they're doing that via gold. Gold has become not just a safe haven asset that it always was, but in my mind, it's now the ultimate safe haven asset in this world. And you see China and Asia bolstering their gold reserves. China is trying to become the third international hub in gold. They've done so many different things. They're allowing their top 10% of insurance companies to invest 1% AUM in gold. That estimate's almost $25 billion. They're relaxing rules in trading on the SGE and the SHFE. They're opening up vaults. They're trying to attract central banks, which I don't think they'll be successful in storing gold there. But if you take a look at the regions, Asia, Middle East, Europe, all the central banks in the world are diversifying away. And it to me is more economic uncertainty than geopolitical, in the sense that since President Trump has come in, and I won't get involved in giving an opinion on the administration, other than that they're quite inconsistent and flip-flopping. Tariffs yes, tariffs no, and aggression as far as military, so forth. So I think a lot of countries around the world are quite nervous, and therefore this rally is different than any other rally we've ever had, because there's a structural change in the investment in gold, and that's with central banks who are very deep pockets, and that's why I believe that we will continue with the U.S. administration not being clear on what they want to do, and with that, I think that this continued diversification will happen.
You've been tracking what looks like an unprecedented drain from the COMEX vault system. More than 27 million ounces of silver gone in just 2 weeks. Is this simply metal moving to meet delivery demand overseas? Or is it the exchange facing a genuine liquidity crunch?
Yeah. So, I mean, again, this is much more silver related than gold related, because the bottom line is the bullion banks. And bullion banks are the intermediary for the gold industry. I mean, they're the ones that finance mining companies, they finance fabricators, refineries, end users such as jewelry companies like Tiffany's and so forth. They lend metal to them and so forth. So I think that there's enough gold in this world that if they needed gold, they can go to central banks to borrow gold. However, that's not the case in silver. There is no lender of last resort. Right. And that's that's the problem we've seen. Arbitrage is something that goes two ways. So then when the price coming off, and then with lease rates going to 150% for overnight, 25% for 2 and 3 months, the EFP for silver went the other way, where spot London became a $3 premium to December futures. Now, December futures should always be higher than spot London because there's a time difference. We're in October, and December futures obviously starts, the 1st of December. So what happened was banks were able then to sell spot London, buy back their short CME position, take delivery of the CME, and start shipping it over. And that's what we've seen in the last 2 weeks. We went from 530 million ounces to approximately 501 million today. So that roughly 29 million ounces of silver has been shipped out of the States. I don't know yet if it's all gone to London. I doubt it all. Some has probably gone to terminal markets like India as well. But this concept of the arbitrage reversing itself has put in the minds that the market should self-correct. I believe that we need another 100, 150 million ounces physically in London for us to normalize. And the reason for that is if you take a look at Dan Gall at TD did an amazing study. I think you've probably had him on before.
Yeah.
He's the one that came up with this. Is this the silver squeeze worth buying into? And he was 100% right. I was with him 100% of the way since November. And what happened is he analyzed free-floating silver. So the simple explanation of that is you take a look of how much silver is in the London warehouses. And I think it's approximately 800 million ounces of silver physically in the London warehouses of the banks. However, a portion of that is allocated and can't be used. So the question is how much free-floating unallocated silver there was. When he did the study, there was 305 million ounces of free-floating stock. To give you an idea of what that means, the daily trading volume was probably around 250 million ounces.
Hello, Bob. I got to cut in here real quick. This is a common piece of London precious metals propaganda both you and a recent Bloomberg journalist used when referring to London's unallocated silver trading on a daily basis. The common inference is that 250 million ounces of daily silver trading on screens gives the impression that somehow 1,000-ounce bars are actually being moved about, but it's actually unallocated price exposure. That's it. Longtime London precious metals trader Peter Hambro admitted on July 4th, 2022 in the Reaction website, which has since scrubbed the article, but I have a thing called the Wayback Machine, so I saved it. And I published it all over to remind people that he spent decades working in London in the precious metals arena, and he suggests that the unallocated precious metals market is a complete bamboozle market flooded with paper trading on screens, and not real price discovery with actual bullion is actually occurring. Estimates of leverage within London's silver market are multi-hundreds of ounces of paper silver versus 1 ounce physically settled, that basically on a daily basis. Okay, carry on.
So if you have 305 million ounces and there's 250 million trading, you have enough silver, and therefore things are going to be liquid. And silver forwards were close to money because of that. Then all of a sudden, you got drained with silver going to the CME, you got drained with silver going to India, you got drained with silver going into ETFs, and that free-floating stock went from 305 million down to maybe 125 million. And the daily trading volume that was maybe 250 million probably went closer to 275, 285 million ounces. And that has what's created this entire tightness, is because there wasn't enough silver to trade on a daily basis to satisfy all the deliveries. And eventually, whoever was lending into this market eventually had to cover, and other banks had to cover, and there was panic. And I'm sure compliance and risk departments came into the banks and said, "Hey, we saw what happened in COVID. We saw what happened earlier in tariffs. Get out." So that exasperated it. Banks started taking less risk, started widening their quotes, and that also funneled it. So, like if, for instance, a 2-month silver forward was quoted at 50 basis point wide, now they started getting quoted 10% wide. And if somebody borrowed at 10% wide, then you would shift that market another 10%. So this is what explains why the silver market panicked, and also with the amount of risk that was taken, which wasn't much, why we got to what I call the market broken.
Right, right. Okay. Well, I mean, one of the things I heard you say there is London, it needs about 100 to 150 million ounces just to kind of function smoothly. That's not a trading issue. I mean, that's a synthetic shortfall. Does that mean we're at the point where the pricing mechanism itself could break unless that metal appears?
No, I don't think it has an impact on pricing as much as it has an impact on liquidity in the forward market and the leasing market.
Okay.
I believe that eventually that liquidity could come back. Another way banks have recently developed some liquidity is they borrowed the SLV, the ETFs, and they borrowed the stock, paid a fee to borrow the stock, then took that stock that that has allocated metal. For those of your customers that wonder, is there really allocated metal? Yes, there is, and banks have actually borrowed the stock, redeemed the stock for physical, and that also has helped inject a little liquidity into this market. Except for I still believe that if we're going to normalize to where we were a couple of months ago, I still think that we need that free-floating stock to equal the daily trading. So that's why I come up with my number of if and I'm not the expert on how much is free floating. I've been going off of Dan Golly's numbers, but let's say make up it's 125 million and there's 275 million trading on a daily basis. You really need to get to that number of free floating in London for it to become liquid and normalized. The price obviously will fundamentally be supported by this shortage as well, because if you can't finance by leasing metal, you're going to have to go out and outright buy it.
Let's switch over. I mean, we established that there's that insensitive, I guess we could call, buyer in London. Who's the seller? I mean, who's standing on the other side of this trade, willing to give up physical metal during a historic drain? I mean, is it just the arbitrageurs, or are there entities, perhaps funds, and those margin calls a little bit that we were talking about, who are being forced to sell that physical metal into the tightness to raise cash?
No, I think it's much more the opportunistic profit motive of banks to. Okay. I mean, if you could sell London spot silver at $3 over December futures, and then you could go in and, let's say, borrow the metal for the time that takes to physically deliver it. It takes most silver is, first of all, done by boat, and the reason for that is the weight and the density. But you can ship silver by plane. The only thing is you're limited to 250 to 500,000 ounces or so, and so you can't move large volumes by plane. But as that spread widened, it made sense. Even I think it's. If from my old days, it's like 8 to 10 cents by boat and maybe 15 to 18 cents by plane an ounce. So as it widened out, it allowed you to move the silver physically by plane and as well as boat. So if you could sell silver at $3 premium spot to futures in London, and let's make a number up and say with cost of shipping, the cost of borrowing the metal for the time it takes, because you're selling spot silver that you don't have. Now you have to go and borrow that silver. And that's what happened with that's why the OTC also got so tight, is because all these banks were taking advantage of this arbitrage and more borrowing came in it. So if you're able to do that, and let's say, for instance, make $1 an ounce on 1 million ounces, that's $1 million. If 30 million ounces move, that's $30 million. So now you understand the economics of why the banks would do this. So.
All right, that's enough. I'm pleased to have seen in the comments over the near 45-minute video on YouTube, a handful of viewers out there knew the backstory about Robert's career in the precious metals markets, and they weren't having it. Moving on to look at silver reports around the world, Turkey imported a nice chunk of close to 3.75 million ounces of silver bullion for the month of September. Of course, that's last month's flows, which occurred before the stuff started to hit the silver squeeze fan in London this month, October. And if your local fiat currency market looked like this, you'd be saving hard in bullion too. Likely it's London's #1 silver importer, India, that set this thing off with its massive unsecured silver ETF demands of late. Well, good luck, Indians, finding silver elsewhere, because from the looks of it, China's combined Shanghai Gold Exchange and Shanghai Futures Exchange silver warehouse inventory levels have been steadily falling since their peak in late 2020. China has seen over 170 million ounces of industrial silver outflows from its two respective warehouse exchanges. Only 71 million ounces for the world's largest industrial silver bullion consumer. That's just not that much. And it looks like Chinese investors are also beginning to join the buy silver bullion bar trends worldwide. So good luck. Dear Chinese viewers, your local silver prices have to basically double and a half in spot prices simply to meet what gold has already done in China since its legit cup breakout beginning in 2023 until now in 2025. Stack silver if you want better performance long term, but get ready for major volatility along the way. Speaking of volatile comments of late, I forgot to show you the soon-to-retire CEO of this hideous pretend Art Deco headquarters for JP Morgan. Well, he was out and about last week, basically telling people in public that $10,000 an ounce gold makes sense in the world we live in now. Have a listen to Jamie Dimon's comments from last week on gold.
Gold, overvalued or undervalued?
I don't know. I mean, I'm not a gold buyer. It costs 4% to own it. It could easily go to 5,000 or 10,000 in environments like this. This is one of the few times in my life I said it's semi-rational to have some in your portfolio. But asset prices are kind of high, so I'm not. Yeah, in the back of my mind, that cuts across almost everything at this point.
And there you have it, fellow plebeians. One of the world's most overpaid CEOs just dropped five-figure gold, confirming the ongoing thesis I've been pounding the table on for years here. Thanks, Jamie. Well, after this short break, I want to give Silver Bullion Bull viewers out there an idea of the coming timing for the emerging Silver Bull price runs to come based on past historical data. I'm also going to leave links in the show notes of many intra-week video updates myself and the team here at SD Bullion published this week to give you all a better sense of what's happening both behind the scenes and how price action has been behaving of late. Stick around. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates. And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
Yeah, and I think since we've launched the SD Bullion IRA program, we've even gotten more insight into this industry.
Right.
And you start to see like the email, the unorganization, and things make sense of why things take so long. When you use the traditional three, separate entity model, nobody's doing checks and balances with each other.
And like you said, there's horror stories now that that people are reaching out like, hey, the depository says 4 years ago they didn't get this inventory, and it's like this is crazy, guys. Like compared to our facility, everything, literally every inch of this facility is under camera.
I hope you enjoyed this short clip from my recent conversation with SD Bullion founder Dr. Tyler Wall. If you're interested in opening a gold or silver retirement account, then this video is a must-see. The insights and strategies that we reveal have helped SD Bullion customers save hundreds of thousands, if not millions of dollars inside their gold and silver retirement accounts. After $5 billion in transactions with more than 400,000 customers, I assure you, this video might be the most important thing you do for your gold and silver future. Visit ira.sdbullion.com/video today. There, you'll be able to gain full access to the entire interview, and you'll also be able to watch more short clips from our conversation. That's ira.sdbullion.com/video. I hope to see you there.
Silver and gold traded down on the week. The spot price of silver closed at $48.51 an ounce bid, with the spot gold price ending the week at $4,108 an ounce bid. The spot gold silver ratio is still historically high, floating higher this week and ending at 84. On Sunday, November 2nd, the Day of the Dead, following All Saints' Day on November 1st, and in the spirit of Halloween, hopefully you liked my new silver art skull. I'm going to report to you next week from New Orleans, Louisiana, where I'll be attending the USA's longest-running gold and silver-focused investment conference. A link for tickets to the conference are in the show notes below. If you're around in the region, I hope to see you there. We're going to end tonight's weekly bullion market update with a wonderful chart and silver-related data set provided by this man, Jordan Roy Bryan. But first, let's look back in U.S. financial history for a brief moment and recall the first time levered paper gold contracts blew the U.S. price of gold, and even silver as well, into a then mania phase never before seen in the nation. It was in the year 1869. Back then, not much bullion actually changed hands, certainly not in comparison to the frenetically levered long silver and gold futures contracts that made the prices of both precious metals run up walls and call into account the then overprinted full fiat greenback used to finance the then recently ended U.S. Civil War. Well, in that same year, 1869, while speaking at a monetary conference debating over gold and silver, etc. in Paris, France, Baron Rothschild stated the following publicly, quote, "The suppression of silver would amount to a veritable destruction of values without any compensation." And so they did. Silver was demonetized in 1873, and the Western USA basically got great taken over the next 3 decades, which followed, being crushed by debts paid in gold, which of course went into premium without silver to keep it in check. And that was the first cup of the 1, 2, 3 silver price history step in U.S. financial history, hitting a low of 25 cents an ounce in 1933 silver, running to a nominal price high of just over 50 an ounce by January 1980 in fiat US dollars that were much more powerful then versus what they are today. Now we're threatening in the present-day silver market to begin to climb towards an eventual Cup 3, a climb that will likely take us to triple-digit landia per troy ounce silver. And that won't be the end either. Until we've come to account with our world record and growing $38 trillion debt pile and hundreds of trillions in unfunded liabilities increasing, coming due this decade into next, well, silver is going to store value scream through that reckoning. Industry colleague and ex-feed friend Jordan Roy Bryan of thedailygold.com and the Daily Gold YouTube channel, he had a wonderful video and chart that overlaid silver's price breakouts from the old 1, 2, 3 silver steps of the last Western world-driven silver bull market from the late 1960s until 1980. If silver were to perform on a percentage basis, as it has in the past cup breakouts from 1967, 1973, and 1978, and of course the 1978 one went off the page into mania phase, with 400% or so. Well, pick and mimic any of them, and we're talking about nearly doubling of spot silver price within the next year of time coming. Of course, gold has already paved the way, having doubled from its old $2,000 an ounce launch pad a few years back, so to see silver do this in a worldwide bull market ongoing, well, that's to be expected. Take advantage of still low premiums on 90% constitutional U.S. silver coinage while supplies last. Maybe even grab a couple of those great granddaddy hoarded gold coins. About 3 of 4 of our ancestors didn't turn them into the feds during the 1933 default on U.S. citizens and the great taking that, of course, continued onward that decade. That will be all for our week's SD Bullion Market Update. And as always, to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.